Welcome to Financial Investing Radio, where you'll learn the secrets for consistent, high-probability returns in the financial markets for additional income to change your life. Grant creates consistent, high-probability trading systems for the financial markets and has applied them over the past 5 years. He's only recently started sharing these tried and true market secrets. As a gift to listeners, Grant is offering his high-probability indicators for free. Go to financialinvestingradio.com and download yours today. Now, here's your host and trading veteran, Grant Larson.
Hey everybody, welcome to another episode of Financial Investing Radio. My name is Grant. Hey, on a previous podcast, I had mentioned the term reversion to mean or mean reversion. One of my listeners commented on that, asking for more information. So let me start with that. I thought I'd spend some time there, make sure we're all in the same playing field. So mean reversion is the theory that suggests that price will move back or eventually move back towards the average. All right, and this mean can be the historical average of market price. Now we'll talk about the probabilities of that and so forth. Now, sort of thinking back, as we were raising our children, near our home there was a place filled with trampolines. I think it was called Jump Street. And our kids loved jumping on the trampolines there. They had, some trampolines that were horizontal. They even had some that were at an angle, so you could they're up against the wall, so you could run up to them and bounce, and it'd throw you back to the horizontal ones. So it's kind of like the markets, right? These trampolines, right? For example, when we bounce on a trampoline, we go below sort of the static surface of the trampoline and we propel up. And likewise, as we reach the apex, we fall back down. Now, in the market though, prices don't always revert to the mean, but there is very often mean reversion. So a very key skill about mean reversion is to know how to spot those opportunities. It's because market prices go sideways at least half the time. But the real question is what does it mean in order to have mean reversion, right? In other words, it's the average of what, like over what period of time? And I spent some time working through that, trying to figure out, do I do this on a 5-minute chart? Is it on a weekly chart? Is it a monthly? I mean, what's the average that you pick that's going to be most meaningful? And some of that has to do with what kind of investor or trader we are. But I ran into something that was a huge impact to my trading, and that was to use something called channels, and to use channels in a way that helped me to spot those opportunities of mean regression. So let me explain it this way. A few years ago, we were in the mountains. It was in the summertime, and we were at one of the ski resorts. I don't remember the name of it, but it had something called an alpine slide. Now, it's kind of like a bobsled channel where you sit on a sled. There's, of course, no snow because it's during the summer, and you're in a slide, or you're basically in a channel. So it has sides that come up on the left and the right-hand side. It's open above so that you can see the sky and whatnot. But nevertheless, you're in this channel. Now, on the alpine slide, there's a few things, of course, you want to know, right? You've obviously got a brake handle that'll help slow you down. And as you go down the side of the mountain in this channel, you hit one side of the channel and it knocks you back to the center, and then you hit the other side, and again it knocks you back to the center. Now the market prices, or I'll refer to that as price action, is a lot this way. There's a channel of price movement, and what varies is the steepness or the grade of the channel. So now on the alpine slide, you would never want to break out of that channel for obvious reasons, right? You could certainly get hurt. But in the market, it does this all the time, all right? So price comes along, bouncing along a channel, and then wow, bam, it shoots out of the channel for a bit. And sometimes it returns and comes back into it. Now, channels on charts is a personal favorite of mine. It takes some practice, but it builds on your experience with drawing trend lines. Now, I'm sure you've already been drawing trend lines, right? As you know, when you draw a trend line, you're looking to connect two places where price has turned around and gone the other direction. Lots of times we call these pivots, right? So let's say the price was coming down, then went back up, and then later came down maybe a little bit further and went back up. Those 2 points where it turns around, each of those points are called pivots. And when we draw trend lines, we draw those along those pivot points, right? We connect the dots, something we did as kids, right, in the coloring books. Well, we do the same thing with channels. So we draw the channel lines that connect the pivots. And we only need 2 pivots on one side and 1 pivot on the other side. So let's say that the channel is going down. Then I want to draw 2 pivots at the top first, and then I come down to a lower pivot where prices come down and headed back up. I connect the bottom part to that. And then what you start watching for is how the price action behaves within that range, within that channel. All right, so now thinking back to this Alpine slide, we can think of a downward channel on a chart. It's kind of like an Alpine slide, right? And within that downward channel, price goes down for a bit, and then it actually hits the bottom of the channel and then bounces up and goes all the way across the channel, and then it gets up to the top of the channel or somewhere near it, and then it turns around and reverts back to the center of the channel. This kind of reversion is more common. The reversion to mean within a channel. So it doesn't necessarily mean that price is going sideways, although that is certainly one kind of channel, no doubt about that. But more importantly, it's to identify the channel, the steepness of it. It may be flat, right? But the steepness or the direction or the angle of the channel can be up, down, sideways. So before we go further, I'd invite you to make sure you practice applying this on your charts. Understanding the range of motion for a particular instrument that you're investing in and trading is critical. And so that helps you understand opportunities. You know, if I've got a good opportunity or maybe not so good opportunity, it's about the location. And channels help us to do this. And knowing that when it hits the edges of the channel, then it has some higher probabilities that it will revert or go back to the mean, meaning to the center of the channel itself. Okay, now I want to share a few secrets with you that I've learned about channels and how they've really impacted my trading. I don't invest and trade without them. Or to say it the other way, I always invest and trade with channels up. All right, so I have a couple charts, and one of those definitely shows what's the current channel that the market's in, or does it look like it's breaking out of this channel and now it's going to create a new channel and go a different direction. But it's critical to know that. Okay, here's 3 secrets. Number 1, one of the highest probability moves of price is near the 3rd point on a channel. What does that mean? Well, so draw some channels and test it out yourself. But let me see if I can draw a picture in your mind, all right? So let's say that we have the channel that's moving down, kind of like this Alpine slide, right? The Alpine slide's got edges on both sides, price is going down, but it's bouncing back and forth, all right? Now, to draw the channel, we start with the 2 pivot points on the top, right, where prices turn down, and we draw the top part of the channel. Now we look for 1 or 2 lower pivot points to draw on the bottom part of the channel. All right, now let's say that the price is just hit the bottom part of the channel. We just drew it down there, and it's now moving up across the middle of the channel, and it's reaching the top of the channel now, right? That when it touches, that will be the 3rd touch at the top of the channel, all right? Now, that 3rd touch is one of the highest probabilities that it will revert to the mean and go back to the center of the channel. So let me say it again. When the channel, when price comes up and touches either the top or the bottom of the channel, depending on which direction the channel is going, when it does that 3rd touch, you be prepared for a higher probability entry to go the opposite direction. So even if you're trading on a daily basis, some stocks or some options, and you've got your channel set up and it comes across and it touches that for the third time, you know you've got an opportunity that has much higher probability with you. That is reversion to mean. That is the most common reversion to mean that I've seen, and this first secret is that if it's the third touch on the edge of the channel, you have the highest probability that it reverts to the mean. All right? Okay, here's secret number 2. The steeper the channel, the more likely the price action will move out of the channel. All right? So if the channel direction is largely sideways, what I've found is you can get 4 or 5 or 6 touches on each side of the channel. Now, the more touches that there are, then the lower the probability of reversion, right? Because it keeps testing a particular area and finally it says, okay, I'm done testing this area, we're going to move past this now, right? The buyers and the sellers sort of wear out at the prices at that level. All right, but when the channel is very steep, there's a much higher probability that price will break out earlier out of the channel. All right, so think back to the Alpine slide. Let me say it this way. If the mountain is very steep and you're going fast around a corner, right, and that corner represents the edge of the channel, the probability is much higher that you'll fly out of the Alpine slide. In this case, you'll fly out of the channel. That's all we're saying here. Okay, so if it's really steep, if price is going down really fast over a short period of time, it's still bouncing back and forth within a channel, but if it's really steep and going fast, then it seems to take fewer touches on each side of the channel before it breaks out and gets out of that channel and may ultimately go another direction. So in making investment decisions, be aware of the grade or the steepness of the channel. The steeper it is, again, the chances for fewer touches, whereas the more sideways it is, there's a bigger chance that it will bounce back and forth for a little bit longer period of time. Okay, secret number 3. When price breaks out of the channel, because price always eventually breaks out of a channel, no channels forever, all right? So when it breaks out of the channel, it actually provides another opportunity to invest. And maybe it might not be thinking in a way that you're thinking. Here's a scenario. Okay, let's go back to the Alpine slide. So you're going down the Alpine slide, you go too fast, and you shoot out of the channel and you fly out of it. But let's say you don't get hurt. So what do? Do you walk down? Well, maybe. I suppose you might. But, aside from all the other safety considerations, you get back in the Alpine slide and you keep going. And, the market does that a lot. So, say it another way, when price jumps out of the channel in the market, look for opportunities at support or resistance lines outside of the channel that will cause it to turn around and come back to the edge of the channel. Now, if that last part wasn't clear, I can cover that more at another time, so let me know, because I just said a lot right there that is actually very critical to your investing and trading strategy. If you have your channel set up and price breaks out of it and it moves away from the channel pretty quickly, there is high probability that it will actually come back and touch the edge of that channel again. That gives you opportunities for reinvesting, or for buying, or for shorting, depending on what your investing strategy is. So those 3 key secrets, don't forget. First one is one of the highest probability moves is near the third touch on the edge of a channel. That is a high probability move that it's going back into the center, meaning mean reversion of the channel. That's secret number 1. Secret number 2, the steeper the channel, the more likely the price is going to jump out of the channel earlier with fewer touches. So be aware of the angle of the channel. And secret number 3, when it breaks out, it provides an opportunity to invest. It generally comes out and then turnarounds and comes back and touches the edge of that channel where it came out of. Okay, so price action spends the majority of its time moving in a channel, right? Whether it's trending market or a sideways market. So always be looking for the channel. and always looking for the reversion to mean. All right, and that will make a big, significant difference to your trading. It really impacted my investing strategy when I discovered that channels are a fundamental part of this, and they appear at multiple levels. They appear at very small time frames. They appear, of course, at large time frames. So it's worth your investing strategy. Take some time to get to know it and understand what the mean to reversion is. It tends to work best to look for mean reversion across channels. All right, so give it a try. Draw some channels on whatever time frame you're using, and look how that can benefit your investing strategy. Okay, that's it for now. Thanks for joining. I look forward to feedback and future podcasts with you. My name is Grant. Until next time, trade with your channels.
Thank you for joining Grant on Financial Investing Radio. Remember to subscribe and leave feedback. Don't forget to download your free high probability indicators before your next trade. Visit financialinvestingradio.com now.